Gold prices are now above 4,400. 4407 as I am recording this video on Wednesday afternoon. The market's been closed now for about an hour and a half. At one point, we were a bit higher during the day. I think we closed about $25 off the day's highs. Silver had a bigger pullback from the highs, but it's trading above 65 at 65.21. It was above 66 earlier today. Now, it was already strong. The precious metals in general were stronger even before we got the CPI. And they got a little stronger as a result of the CPI, but not much. And you know what I think is interesting is the last several trading days, the gains have been taking place in Asia right away. Buying is coming out of Asia, and there's some bit of a pullback in our time zone in the U.S. And if you recall, when we had the big gold and silver rallies that ended when the Iran war began, at the end of February, early March. If you recall those days, and I was talking about it on the podcast, but during those days, we were seeing all the strength in Asia. Obviously, that's where the buying is coming from. Like the Chinese are buying when they're awake, not when we're awake. That's when they're asleep. So the big buying is coming out of Asia, which makes sense because that's where all the surpluses are. And so they're accumulating, foreign central banks are accumulating gold. And so I think that trade, that de-dollarization trade is back on. And the disaster of a situation that we created in Iran, and I'm going to talk more about that in the last segment of the podcast, but that is, I think, fueling the resurgence of the de-dollarization trade. But in the meantime, I want to stay a little focused on the debt. The national debt now is over $39.85 trillion. So we're now less than $150 billion away from 40 trillion, which we're going to hit that obviously within the next month, because last month we ran up over $400 billion of debt in a single month. And so we only need about 150 billion to get to 40 trillion. That is the big number. That is what investors should be paying attention to. The rest of it is a bunch of noise. The monthly CPI numbers are immaterial. They're obviously going to go up because of what we're doing on the fiscal side that is ultimately driving the monetary side. And in fact, look at Trump now, again, upping the pressure over the last week or so on Lisa Cook, right? Trying to get rid of Lisa Cook because he wants to substitute her with another lackey who's going to be voting for rate cuts. That's what he wants. Trump wants rate cuts. He wants more quantitative easing. But of course, we've got more quantitative easing. In fact, look at the Japanese yen. I've been talking about this. We're back above 159. The effects of the intervention are wearing off. Soon it'll be north of 160 again, which means they're going to have to intervene to stop the yen from falling, because if they don't do that, it's going to put more upward pressure on inflation and long-term interest rates in Japan. The yields on the JGBs will be under pressure as the yen goes down, and so there's going to have to be more intervention. And what does that mean? Well, that means that the Bank of Japan, or Japan, is going to have to bring more U.S. treasuries to the Fed that the Fed is going to buy so that Japan doesn't have to sell them.
As of early August 2026, total U.S. gross national debt sits close to $39.9 trillion, on pace to cross the $40 trillion mark by roughly the end of the month. Some economic commentators argue this figure, not the monthly inflation report, is the real number investors should be tracking, since fiscal deficits are what ultimately drive monetary policy over time. With the debt climbing by tens of billions of dollars every few days and interest costs now eating up a growing share of federal spending, the pressure to keep borrowing costs artificially low keeps building quietly behind every market move.
And one interesting point that I didn't even bring up last time when I talked about this is these repurchase agreements have a maturity of 30 days. So in theory, Japan is supposed to buy these treasuries back from the Fed in 30 days. Now, what's the odds they're going to do that? Because where are they going to get the money to buy them back? Obviously, if they had the dollars lying around, they wouldn't have needed to do the swaps in the first place. So they're obviously not going to do it. So what are they going to do? Are they just going to constantly roll these things over every 30 days? Now, what happens? I'm not sure. What happens if Japan just says, we don't want to buy them back? I mean, I don't know if they're required to buy them back or that's just an option. I think they decide they can just leave them with the Fed, and then the Fed is stuck with them. Then it's just pure QE, right? Because now the Fed would have bought those bonds, but instead of going into the market and buying the bonds, it would have just bought them right off in Japan. So it's a direct benefit, a direct subsidy to Japan, because Japan ends up getting out of its bonds at a higher price than it otherwise would have received if it had to sell the bonds into the market. But we still end up creating inflation. But now we have a pathway for the Japanese to unload these bonds without crashing the market, because the Fed is basically going to say, I got you. Don't worry. We'll do an off the books transaction. We'll buy in bulk so you don't have to hit the bids in the market. So we'll see what happens. But this is what investors should be focusing on. They should be looking at the budget deficits here. They should be looking at the budget deficits in Japan. They should be looking at the yen. And again, prices don't tell you the story when it comes to inflation, because prices rise as a result of inflation. They are not inflation. I mean, that's like waiting for the sidewalks to be wet to try to forecast whether or not it's going to rain. I mean, by the time the sidewalks are wet, well, obviously the rain is falling. You got to, try to look at the weather patterns and try to predict, is it going to rain? Don't wait till everything is wet and then say, yeah, it's raining. And so when you look at inflation, you look at these things that I'm talking about. You look at the budget deficits. You look at the money supply. You look at the balance sheet. You don't look at the rearview mirror. Plus, as I've said many, many times, the CPI doesn't even tell the truth about how bad inflation is because of the way it's calculated, the methodology for computing it. It deliberately understates the numbers. Now, we're going to get the PPI tomorrow, which probably does the same thing, but the PPI has been running hotter than the CPI, which in and of itself is a leading indicator of where the CPI is going. But as I've pointed out, looking at the import-export numbers, which are far less adjusted than the CPI, that's a better indicator of prices. But again, when you're looking for inflation, you don't look at prices. You look at money supply. And even Milton Friedman, inflation is everywhere and anywhere a monetary phenomenon. So if you want to know where inflation is going, where is money supply going? Where is credit going? And it's going to continue to expand. And in fact, even now, I'm looking at all these numbers on delinquencies, auto delinquencies soaring. In fact, more auto loans now are getting rejected because people have so much debt they can't even qualify for the loans. Same thing's going to be happening in the mortgage market, credit cards. All this debt is exploding. Delinquencies are at the highest they've been since the tail end of the Great Recession. They're going to go a lot higher than that. So that means the Fed is what? They're going to flood the economy with even more credit. That's what happens when you can't pay back the money you've already loaned. They just make it easier to go into debt and borrow even more. The opposite of what they should be doing.
Japan's yen has repeatedly slid past the 159 to 160 level against the dollar this year, a threshold that's historically triggered intervention to head off a disorderly slide. Rather than letting Japan sell U.S. treasuries outright to raise dollars, a move that could rattle bond markets, commentators point to a workaround: short-term repurchase agreements that let Japan post treasuries to the Federal Reserve in exchange for cash, technically due to be repurchased within 30 days. Critics argue these arrangements risk becoming a rolling off-market substitute for the Fed effectively buying the bonds itself, functioning much like additional monetary easing without ever being labeled that way.
I also wanted to circle back and talk a little bit about markets because I haven't said anything about Bitcoin, and I wanted to talk about it in this podcast because what's interesting about the last week or so, and particularly the last few days of this week, the first few days, we've had a big rally in risk-on and risk-off assets, especially the names related to AI. All the tech companies, the AI names have had huge rallies off those big lows. Now, some of that was because we basically flushed out the hedge fund situation awareness, right? Had to sell out a bunch of his liquid positions. And I think after that came out and we got some more earnings reports and some more news that kind of rekindled the speculative spirits in these names, we had a big rise in all these stocks. Like even SpaceX, which was getting beat up for good reason, probably the most overvalued stock there is as far as, looking at the sales and earnings or lack thereof. But now SpaceX is back above the IPO price. So there was a speculative fever lit. And at the same time, we had the big rally in gold and silver and in mining stocks, which again, last week they were up over 20% in 1 week. And, they rose again a little bit this week. Metals prices continue to rise. I think that trend is going to continue. So we got gold and silver, inflation hedge, they're going up. And then you've got tech stocks. They're going up. Now, you could argue some people are buying tech stocks as an inflation hedge, but in general, they're looked at as a different type of investment. Yet, look at Bitcoin. Bitcoin did not do anything. In fact, Bitcoin is a little bit lower than it was a week ago. It's lower on the week. As I'm recording this, Bitcoin's about 63,500. It's not going anywhere. It's not rising with the tech stocks like it once did. It's not really rising with gold and silver, which it never really did, but it's not going up at all. And I keep seeing all these people claiming, well, just wait, it's going to happen. They're saying that there's a lag, that gold and silver move first and then Bitcoin follows. Says who? I mean, maybe it happened once before, but once does not a trend make. Just because something happened one time, even if it happened 2 or 3 times, doesn't mean it's always going to happen. And I keep hearing these crypto guys saying now they're bullish on gold, silver, and Bitcoin. I'm seeing more and more people in the crypto community who used to trash gold because they said, look, Bitcoin's the new gold. Bitcoin is digital gold. You don't need gold. Now they're trying to wrap Bitcoin in this gold wrapper by saying Bitcoin is just like gold and silver. They're all going to go up. It's just that gold and silver are going up first. Bitcoin's just going to go up last, but it's going to go up more. Says who? Who says it's going to go up more? I mean, that's just wishful thinking. If you want to give people the benefit of the doubt and say it's wishful thinking, because it could just be outright lies, right? They're trying to talk their book. They're trying to pump the thing up. But a lot of these guys do believe it. I mean, they're so caught up in it that they actually believe this nonsense. But they think if we just hold Bitcoin long enough, it's going to go. No, it's not. The longer you stay in Bitcoin, the more of the gold and silver rally you're going to miss out on. And eventually, the bottom's going to drop out of Bitcoin. I don't really know what's holding it up now. Certainly it isn't Michael Saylor because they're still selling. But there's just hope. I mean, that's what's irrational hope. And of course, there's probably still fear. I think there are people that own Bitcoin that are afraid if they sell it, then the train's going to leave the station without them, right? So they don't want to give up. But at some point, you're going to see that kind of capitulation. In fact, somebody was making the point on CNBC, and they were making this as a bullish argument in favor of Bitcoin. And he said that if you look at the ETFs, that so far in the ETFs, there's been very little redemptions. That maybe only about 10% of the people who bought the ETFs have sold. And in his mind and everybody else's mind on CNBC, oh, this was good news because it showed that this is strong hands. And in my mind, it was like it's bad news because we've had this 50% drop and barely anybody has sold. So what's going to happen when they do sell? Yes, maybe they've stuck it out for the first 50%. But once we really start to go down, once Bitcoin cracks below 50,000, going to 40,000, 30,000, I don't think that all these ETF investors are going to go along for that ride. They're not holding, ride or die to eternity, right? They are not true Bitcoiners. If they were, they wouldn't own their Bitcoin through an ETF. Now, would they? They would have it in their own private place with their own keys. Although even that, I read a story recently about people who had their Bitcoin in cold storage got stolen. They didn't even have it on an exchange. They did everything right and they still lost all their Bitcoin. But these guys, they're not going to go down with this ship. They are going to bail out at some point. So the fact that most of the people who bought the ETFs and who are now losing money, the fact that they haven't thrown away their hand yet doesn't mean that they're pot committed till the end of the game. No, they are going to take their chips to another casino. And in fact, the more the AI stocks heat up, the more pressure is. It's like you're over at the Bitcoin table and no one's making any money. They keep rolling sevens and you see all these people jumping up and down and screaming at the AI table. They're rolling number after number. They're all making money. Everybody's partying. How long are you going to stay at the cold table before you move over to where the hot shooters are? So this is what's going to happen. So the industry, the media, they're trying to keep everybody in the pot as they get boiled. Jump out of the pot before you get boiled and get into real gold and silver. Don't wait for Bitcoin to catch up. It won't. Just get out now. Recognize you're on the wrong horse. You don't have the fastest horse. You have the slowest horse if you're with Bitcoin. And before that horse ends up in the glue factory, get on an actual horse.
Inflation-focused analysts, consumer price data reflects inflation that's already happened, not what's coming. Milton Friedman's classic framing that inflation is fundamentally a monetary phenomenon gets revived often here, pointing instead to money supply and credit growth as the real leading indicators. Backing up that concern, delinquency rates on auto loans have climbed to levels not seen since the tail end of the 2008 recession, with a rising number of borrowers unable to qualify for credit at all. Historically, tightening credit conditions like these have prompted policymakers to loosen lending further rather than pull back.
Wait, another reason that I think the Republicans are going to have such a hard time with the 2026 midterms and 2028 elections is the sheer corruption of the Trumps and the exploitation of the presidency for personal gain. Even the president's youngest son now, Barron Trump, he's still a teenager, I think. I'm not even sure if he's 20 yet. I forget. He's now worth $150 million, according to independent sources. $150 million. Not even 20. I mean, he had no money before Trump was elected president. His father became president, and now his dad's president, and he's parlayed that into $150 million. And also, you know, I was one of the first people to criticize the concept of charging your subscribers to Truth Social $100,000 to get Trump's posts, you know, a few seconds early so that you'd have a trading advantage. And now they've got 10 people, right, that are paying this about somewhere between 60 and 100,000 a month. And I immediately criticized this. And now, of course, there are more people that are criticizing it. But just this week, DJT Media that owns Truth Social, they came out and they officially defended the practice. And they actually had the gall to say, well, this is standard. This is normal. This is how businesses operate. It's normal to charge premium pricing to get premium access or early access. And I mean, is the public going to buy this nonsense? First of all, this is not a little bit extra. This is $100,000 a month. I don't know any social media service where you pay $100,000 more a month to be a premium member. I mean, this is off the charts insane. And again, you get the same information just a few seconds early. So it's specifically designed for trading. But of course, you can't talk about what's normal in the internet, social media, whatever, when you're talking about a very abnormal situation. You're talking about a company that is owned by the President of the United States. And the President of the United States has the ability to move markets because of his power and his influence. He can say something and then go out and do it. So he can directly manipulate prices. And he's now selling that. And he does it exclusively on his own platform. He doesn't post on X when he's about to bomb Iran or make nice with Iran or when he's about to hit somebody with a tariff or do something. He doesn't go to X. He only posts that on Truth Social. So you've got a company that's owned by the President of the United States that has exclusive access to the president's posts. And now they're charging money for it. And they claim this is business as usual. I mean, this is off the charts, what was going on with the Bidens. So this as well as the weakness in the economy, the runaway inflation, this is going to come back and bite the Republicans. So even as the Democrats, you would think they're self-destructing with these horrible candidates have a very good chance of winning. And so I want to make sure that if they win, the ideology doesn't. And that there's still a lot of people out there that understand free market capitalism. And that's why they got to listen to my podcast.